Thanks a lot for joining. This is our third session after the first one that we did in June, July, and then followed that in October. And now this is our third sort of investor update. And we don't generally have a fixed, timeline as to when do we do this. But I think in the recent, the news that we saw around tariffs and uh, the trade wars that we've seen, it made a lot of sense to do this session and to sort of update everyone on how we are thinking about markets, about geopolitics, about economy in general as well. Uh, so let me quickly dive into this first. Just wanted to talk about our performance. We've been as a business, we've been now 3 years old. Started as a RA, and now we've recently received our RIA license. So we are now a corporate registered investment advisory firm uh, that can, basically provide customized advisory services to all our clients, right? Much like the kind of service that we provide today. And this is our small case performance, which is publicly available on our small case website, wealthculture.smallcase.com. Over the last 2, 3 years, since we've been operational, we've done decently well. Our 2 year, 3 year performance is 35% plus. At the peak of the market, September, October last year, we were doing 60% plus. But of course, those are unsustainable numbers. And with the market correction, we've also corrected in terms of our performance. So moving on, the big, elephant in the room, Trump tariffs, and what is he trying to achieve, right? So what is it that all these tariffs and reciprocal tariffs and trade wars, especially with China, what is the big purpose that US is trying to solve for? And in all this madness, there is certainly a method, right? So there's some broad 3, 4 goals that the US and Trump is trying to optimize for, trying to achieve, which makes a lot of sense, and and we'll talk about it. So basically, if you look at the global trade order, and you have to go back 50, 60 years post the World War. So in 1944, and something called as Bretton Woods system happened, 1944 to almost till 1970s. This system sort of prevailed, and then from 1980s onwards, much recently till 2000, 2001, we saw the neoliberal world order, right? To put it in very simple terms, these orders, these economic orders, were supposed to, uh, and these orders were, for example, countries who signed these orders basically were provided, uh, you know, defense support by US. They were provided free trade agreements. They were provided, economic orders where the trade with those nations would be very, very easy to do, and they will be provided support by the US Army. So in a way, they had the protection from US. So it was much like the hafta vasuli that we do here in India, where somebody would pay for your security as long as you keep the US currency as the reserve currency, right? So that was the top level understanding with all these nations as part of these, either Bretton Woods or neoliberal, where US will sort of be the dada of this world, and the US dollar will remain as the reserve currency, and everybody has to follow that currency. And in return, we will first of all allow free trade, not free trade, but on relatively good terms, we will allow you to trade with US. And what we'll also do is we'll provide you support. So someday, if some country comes attacking you, then we will be on your side, supporting you as a nation. So that is what was done as part of these two economic world orders, economic systems that were prevailing up until now. Now, as part of these systems, of course, dollar remained as the reserve currency, as you all know. Trade for the last 60, 70 years has happened in terms of dollars only, right? But what US has now started to realize is that over the last, 1947 to 2024, their manufacturing output has come down significantly. So in 1947, for example, they used to manufacture almost 27%, whereas that has come down to almost single digit 9, 10%, right? And this, in a way, has sparked a debate around national security as well. because their deindustrialization has been at such massive levels that if tomorrow US were to go on a war with some other nation, let's take for example China, then they don't have the manufacturing ability, they don't have the in terms of self-sufficiency to even go into a full-fledged war. I mean, as of today, they do. Of course, US is the biggest superpower, but the way and the pace at which the deindustrialization is happening, in another 5 to 10 years, they won't have this ability, and by that time, the adversary, in this case China, will become much bigger and more powerful. So they've realized this thing, which sort of so one goal from US point of view is to reindustrialize their economy in a way that they are not dependent on other nations to fight wars, right? So just as a national security threat, they want to reindustrialize. Now we don't know the extent of reindustrialization. Of course, textile cannot move back to US. Of course, a lot of low-end manufacturing cannot move back to US. Maybe they'll try to bring back some of the, defense manufacturing, for example, steel manufacturing, for example, because you can't make missiles and drones, basis the steel that you import from China, right? So that is laughable in a way that you import steel from China and then you manufacture missiles that you then throw back on China, right? So this is probably one of the few reasons that they want to sort of now start reindustrializing USA, right? And so these are the two targets that they're trying to achieve. One is to reindustrialize US while keeping the US dollar as the reserve currency. And this is very important for them because their debt levels are at all-time high, almost $36 trillion of debt. About $28 trillion of that is going to come for reissuing. So they'll have to roll over that debt. And there is one rumor that all of this is being created to reduce the interest rate so that they can refinance that debt at a much lower interest rate, right? Now, how successful will they be in terms of executing the strategy is something that needs to be seen, right? So the first step, and what we understood from so there are two important people, Scott Bessent and Steve Marin. These are the two people who sort of the orchestrators of this strategy as to how they want to reindustrialize US while keeping dollar as the reserve currency, right? So the first step is tariff chaos, where they will start with very high level tariffs on every country, and this is with both with allies as well as with enemies. That we'll impose so and so 25, 26, 30, 35, 40, 50, you name it, and that kind of tariff on you. And the idea is to scare everyone, right? Because US, all said and done, US is the largest consumer globally. So everybody in a way wants to export to US. So for that matter, people will come down on a negotiating table. So they'll first start creating panic. Of course, markets will react to it, which in this case they are not paying attention to. So the tariff costs will then lead to what the step two, which is basically bilateral negotiations with every country, wherein they will decide what is the level playing field, and then they will then do reciprocal tariffs, which is to say that okay, fine, we'll allow you to access US markets, but then we also need these things, right? And you can't play unfair in terms of your currency devaluation. You can't play unfair in terms of trade. Sorry, IP stealing of IP. For example, a lot of what happens in India is just IP stealing, right? And then they, as part of step through, they will probably also try to uh, do a currency deal wherein every country that finally decides to align with the USA will have to peg its currency against the US dollar in a way that the US dollar benefits out of that, right? So one is to obviously uh, you know force countries to reduce their tariffs. Plus, they will also end up doing a dollar, which they call as the Mar-a-Lago Accord, which is the currency sort of, a currency agreement with each country where that country has to, peg its currency against the dollar in a way that the dollar remains the reserve currency. So this will allow US to devalue dollar, to devalue their currency while keeping the reserve currency status. Right now, as much as this is difficult to explain, this is difficult to execute also, very difficult to execute in my opinion, uh, because we don't think US is in terms of enforceability, in terms of negotiation, US is it's probably less important now in the overall scheme of things, and it needs to be seen. So the whole plan and the execution of it depends on how many countries fall into these three buckets, right? So there will be countries who will be called vassals, which is these are your allies who agree to do what US wants to do. They will reduce their tariffs also. They will peg their currency against the US dollar also. So all of these things, these countries will do. Next will be neutral countries, much like India, where we might end up agreeing to reducing some tariffs, but we will not end up pegging our currency against the US dollar. And some countries who will probably just go against it, like the way China is going right now, where they don't care. They'll just put tariffs on top of your tariffs, and then those that tariff war will keep continuing. I don't know till it really starts hurting in these countries. Then again, decide to come back on the negotiating table. So we don't know how these things will pan out, but it looks like majority of the nations are ready to negotiate. Now, how these negotiations go and how many countries are ready to reduce their tariffs, plus also agree to a Mar-a-Lago type of accord where they're ready to peg their currency against the US currency, all of that needs to be seen. But this is the grand game plan which will be executed over the next, I think, I don't know, 90 days is now given. In my opinion, in the next 90 days, they will try and at least do deals with all the major economies, and then over the next 1 to 2 years. So what we will see over the next 1 to 2 is a significant change in global economic order, significant change in supply chains, significant change in US's policies towards other nations as to how much and how easily they allow other countries to access their markets. Uh, and of course, there is a big question on how successful these trade negotiations will be. But one thing is for sure that now every country is on its own. US has decided to back off and not be the big daddy. So basically, every country is now on its own basis. Your whatever, like for example, China's strength is manufacturing. So now, basis China's manufacturing strength, it will now start negotiating with every other country, not just US, but Europe, but India. And so a new economic world order will come about, and the WTO will have very little role to play there, right? So in a way, it's like a new economic order. How these things shape up, only time will tell over the next 1 year, 2 years. So these are kind of uncertain times. Now, when you are in such a situation, the actual GDP impact may not be as high. For example, India exports 2.5% of the GDP to US, and let's say 10-15% of that gets directly affected. So the maths is that for India as a country, not more than 0.5, 0.6% GDP will get hampered because of all of this. But the bigger problem is that because of this policy of uncertainty, a lot of the capex which Indian companies, for example, were planning to do, they'll just postpone it, right? So no incremental capex, at least from the private sector, especially when it comes to putting export capacity or exporting to US to Europe. All of this will be put on hold, and that will have larger implications. That will have level 2, level 3 implications on our economy, right? So of course that will affect the GDP going forward. Now, what they have done is, of course, they've rolled back the tariffs on a lot of countries except for China, where now they are in a trade war with. So I think from our point of view, it becomes very important to monitor the situation and see who emerges as the winner, because this is not just a trade war, but in a way, my opinion is that it will become a geopolitical war, much like what happened at the turn of 19th century when when UK, for example, was going down as a superpower and US was emerging, and we had two world wars, then World War One and World War Two as part of that transition. And in my opinion, now there are two large economies, US and China, which can actually go head to head against each other. So China has over the last 10, 15, 20 years emerged as a very strong player, and somebody who can really sort of question the US hegemony, question the US superpower, and it won't be as easy for US to do all of this, especially with China around, right? So in my view, this is, I don't know if it will escalate, but if it escalates, this can become like a geopolitical sort of Cold War type of thing for a very long period of time, which might not be great as far as global GDP is concerned, global growth is concerned, right? And I think at some point of time, we will have to choose our partners, choose whether we want to go with US or China, both of whom are very, not reliable partners, so to say. US especially has become a very non-reliable partner in the last, ever since President Trump has taken up. We were just, as a matter of just discussion, trying to understand who between US and China can emerge as the winner, and the jury is out there. It's not, but these were some of the points that we were pondering over. So if you look at the US-China trade imbalance, of course, China exports more to US than it imports from US. So there's a trade balance imbalance of $300 billion, which US claims is not right because China devalues its currency, whereas US is not able to. Of course, because US is the reserve currency. So you can't play around with the reserve currency. You can't say tomorrow I'm going to devalue and then I will revalue or whatever. So US is not able to do what China is able to do because China can easily wake up, next day tomorrow and say that, we will devalue our currency. And because of this devaluation, things change. So which is why US sometimes says that China is being very unfair because at the end of the day, you can devalue your currency. And then, so basically US also wants to play unfair now. US also wants to say that, you know what, while being the reserve currency, we also want to devalue the dollar, which I don't know how plausible it is, but we think that 12% of China's GDP is exported to US. So China will, and I think is obviously looking for markets to diversify so that they can reduce the US exposure, which I think they'll be able to. Plus China, because they don't have free and independent elections, so they can go through a major pain. For example, even if the GDP, I think last I know, the estimate is that China will grow by 5%. If China, let's say, doesn't go by 5%, does only grows by 2%, 3%, or whatever, they can still survive because they don't have a democracy. So they can suppress their people, they can do all of that just to keep the war going, and which US cannot. Yeah? At some point of time, they'll have to give up on the war if the pressure builds too much, right? Uh, and the biggest deal, I think, is China controlling 90% of the rare earth minerals. So if you look at the transition to green economy and renewable and solar and all of that, and basic electric cars and all of that, the entire supply chain, at least 95% of the processing of rare earth minerals happens in China, right? So even if the minerals are extracted or mined in some other part of the world, they go back to China for processing, and then from China they then are distributed across the world. So in a way, China controls this entire supply chain, which I think is a huge advantage to them, right? So plus, of course, they are a producer economy, and this is if you look at how when US became the superpower in, let's say, 1940s 50s, then it was the manufacturing. For example, as we saw, 27% of the manufacturing was happening in US, and which over the years has come down. But China exactly is where US was 50 years ago or 60 years ago. And so it makes perfect sense that uh, because China is now has major advantage in terms of its manufacturing capabilities, it is the producer economy, whereas US is just a consumer now. It has been reduced to being a consumer status, and the trade deficit that they run with all the countries is just because the US is the largest consumer while surviving on debt. So of course they are consuming beyond their means. They are consuming beyond what they are total producing as an economy, and which is why they are running huge deficits every year. Almost two trillion of trade deficits. Sorry, almost 2 trillion of borrowing going up every year, and $1.5 trillion of interest payment. So if you remember the last time also we discussed, I focused around this point that the interest payment is the third largest P&L item on their P&L, right? Which is a huge number. So they've obviously realized that they need to cut, which is why they had this Doji initiative, and they are sacking off employees, government employees, and all of that, just so that they can reduce the deficit going forward. So they will have to contract their economy, no doubt about it. I mean, whether we get into a trade war or not, whether this at the end of the day comes in US's favor or not, but they have to reduce their spending. They have to get within their means. They have to reduce their deficits in order to be able to survive and grow as an economy, right? So which is why between the two, we believe China is better positioned, and there is a change in world order which will happen. Now, there is a trade war that has already begun. We don't know if there will be a geopolitical war or if there will be a cold war, which of course will unfold over the next 3, 4, 5 years, maybe 10 years as well. And as this shift happens, this can even take 5 to 10 years or 10, 15 years to sort of, and I think by the end of this century, by the end of this decade and next decade, I think it will be very clear that China is the sort of next superpower. If you read Ray Dalio and read his books and the changing world order, he has sort of focused a lot on this concept of economy is evolving and then the change in world order and all of that. And according to him as well, the next superpower, China will become the next superpower. So now that there are trade tariffs and there's US-China trade war, how exactly this will affect us as India? Are we going to benefit from this? Are we going to be at loss? What is it that we might go through, towards the end of this, right? So we believe that over the next 90 days, of course, US has come out with a list of top 5, 6 countries that they want to negotiate first, and India is also on the list. Now we run a trade again. We have a trade surplus with US, which means we export more to US than we import. So what they are trying to do, and if you look at the trade sort of committee that came from US, one of their asks is that we have to open our economy more and more, and not just trade barriers, but non-tariff barriers have also to be lifted. Just to give you an example, almost 7, 8 years ago, RBI came out with this regulation that Indian data has to reside in India, right? And so whether it's Mastercard or Visa or any of these large US companies, they will have to have data centers in India. They will have to have servers in India where a primary record will be stored of all the Indian citizens. Now the US has come back, not just in terms of tariffs, but non-tariffs negotiations where they're saying remove this regulation and allow and just remove it off where there is no regulation of having data stored in India. So earlier we had our data stored in Singapore and then in US servers. Uh, and because RBI reduced this, we had, if you know, a lot of data center investment in India over the last 7, 8 years. I mean, even in the recent bull run, we saw a lot of data center led stocks do well. But imagine if this regulation were to be removed, then all of those investments will basically, I don't know, the demand for local data centers will go down, and all of that will happen. So that is how these discussions and negotiations are going right now, which will have implications for industries, specific industries, broader economy, and we don't want to bet either in favor or against of these negotiations. We don't know. Let's wait for these negotiations to conclude before deciding which industry to go ahead with and which industry to avoid. But for now, I think broadly we can say, so let's discuss the cons first. I think given the global pressure, let's say even if we don't relent to US, which I think we are more than happy to relent. I think we are ready to reduce our tariffs. If you look at the narrative, we are ready to reduce our narratives, which will allow, of course, allow for a higher competition from other geographies to come into India. And not just India, not just US, but US as also EU, European Union has also asked India to reduce its tariffs because if they are not able to sell their Mercedes and BMWs in US, they would want to sell it in India. And China, of course, has extended a hand. They want India, China, Russia, all of these to stand as a block together. BRICS, of course, as a block together against US to counter these tariffs. And in which case, China would also want to dump their whatever chemicals, cheap equipment that they supply globally into India, right? So all of this, whether it's China, whether it's Europe, whether it's US, it seems like India will have to open up its borders slightly more and be ready for higher competition. And this does not go a lot well with local, for example, MSMEs, local companies manufacturing autos, automobiles, steel, for example. India has, over the last couple of weeks, put a lot of anti-dumping duties. So we were just trying to see what dumping is happening already and how is India trying to counter. So we'll see in what cases anti-dumping is imposed and we avoid all of these cheap. But the thing is, India has a free trade agreement with ASEAN, right? So Vietnam, Philippines, all of these ASEAN countries, we have a free trade agreement. So even if China doesn't export directly into India, it has a way of going through these ASEAN nations, and then it comes into India because we have a free trade agreement with all of these ASEAN countries, right? Which is how the dumping happens mostly. Which is not under our. I mean, we'll have to then go against ASEAN also and say, free trade agreement is not valid now. So basically, India has to renegotiate with every other major economy out there in order to preserve its own interests, right? And which is why I'm saying over the next 6 months, 7 months, 8 months, there's a lot of uncertainty on how these negotiations will go and whether it will work in our favor and not in our favor. But broadly, I'm saying we will have to be ready for higher competition, especially coming from China and Europe. Of course, US will definitely negotiate its way around, and we'll have to reduce our tariffs there as well. There might be some opportunities because, of course, US China will get into a long-term trade war. Maybe if the tariffs are not 145 and 125%, at least there will be higher tariffs, which gives us some advantage with respect to China. And I think some of our China plus one trades will do well. And some spaces, some industries where we generally have an advantage in terms of labor, in terms of cost and all of that, there I think we will do well. So over the next 6 7 months, we ourselves have to figure out if we are doing China plus one, whether it's really China plus one, whether are we able to beat Chinese competition and still be able to export to US. And US might shift its trade balance slightly towards India as well because they don't want to have a $300 billion trade deficit with China alone, right? So in my view, it will get competitive, but there might be some pockets, there might be some opportunities which will open up for India as well. And Indian manufacturing has to sort of uh, you know up our standards and be able to meet the global competition, which I think a lot of Indian entrepreneurs have avoided till date, right? So Mahindra, Tata, all of these companies have really, through the by the means of import duties, been able to sort of avoid international competition. But I think those days are gone. I think our companies have to sort of finally match up international standards, international prices, and really be able to sell globally. Now, while all of this is happening, and we, of course, starting September, I think last year our GDP also started going down. So our government and the RBI together, they have taken some steps to sort of ease the pressure in terms of liquidity, in terms of the stress, the urban consumer stress that we were going through, right? So 1 lakh crores of tax concessions in the recent budget. RBI since January this year has already cut repo rates by 50 basis points, so loans will become slightly more cheaper. Plus, there has been a liquidity injection of almost 2 lakh crores by RBI, right? So I think post the new governor coming in, a lot of things have happened, and most likely this will have some benefit for the economy, right? Now, quickly, I just want to cover major assets and how they have responded to this Trump tariff thing, whether it has gone in favor of US, not in favor of US. So most of the reaction has been anti-US, right? Which is where US had to go on a back foot and say that we are removing tariffs on almost 90 plus countries or whatever, and they are now just continuing to do a trade war with China. So US bond markets, I think last week there was a lot of selling pressure. Almost $200 billion of US bonds were sold in a matter of few hours, right? And because of which the yields went up, right? So I think yields touched almost 10-year high. As you can see, US 10-year Treasury yields post biggest weekly surge since 1981 on tariff turmoil. So I think for a brief while they reached 4.5% plus. And if you know, China holds almost $760 billion of US treasuries. So tomorrow, if China has to really put pressure on US, this is one way that they can do it. they can basically go ahead and sell US Treasuries, which will ultimately lead to the yields going up. Now, why is yields going up a problem? Because what these guys are trying to solve for is to reduce the yield, reduce the 10-year yield so that they can refinance their $28 trillion of loan at a reduced price. Whereas bond markets, if they don't, if the bond yields don't come down, they will have to refinance them at a very higher interest rate. Plus, bond markets are considered to be non-risk assets, right? So stocks are risk assets, bonds are non-risk assets, and this was supposed to be the go-to place. If let's say, for example, there is a stock market selling, then the US Treasury is supposed to be the safe place. But the reaction that we saw last week, it sort of created a lot of jitters in the bond market as well, right? And this is something that can keep happening, doesn't help US economy as a whole, because the entire idea is to reduce interest rates, devalue the dollar, refinance your loans at a much lower interest rate, and this doesn't solve that problem. The other thing is that traditionally what has happened is whenever there has been a problem globally, then people have flocked to dollar. So they have gone back to buying US dollar, and US dollar in all of those cases has gone up. Now, this in contrast, last week, dollar index actually came down below the 100 mark, which is the psychologically important mark. And it is 8% down since the peak this year, right? So in a way, there is both dollar selling also happening. It's not like people are going back to dollar, which was traditionally not the case. And a lot of people are claiming that this is not a buy on dips for US market. So my general also advice to people who have some US exposure is to, excuse me, to not buy the dip, because there's a fundamental shift happening right now, which is very different from the other corrections that were happening over the last 40, 50 years, right? We are looking at a new global order, and US economy by its own strategy is trying to devalue the dollar. So they don't want a strong dollar. Now, I don't know if they're able to do that, not do that, but basically, as part of their strategy, they would rather prefer a subdued dollar because that helps them do more exports. That makes US exports more competitive in the global market. That helps them reduce their trade deficits with the other countries globally. And as expected, gold and silver have continued to sort of go up. There was this one short correction because Trump had removed tariffs on bullion, right? So there was this very short correction, I think, and post that we've again see the gold and the silver recover to all-time highs, and this has been, as you know, since August last year, we've been pitching for gold and silver. We are not generally gold and silver investors. So let me tell you. So when I reached to a lot of clients and said, please buy gold and silver, their first reaction was, we don't want to do gold silver trading. And we don't do gold silver trading. I, for one, have never touched gold and silver my entire life. But this was a very, very tactical bet because we could see some of these uncertainties come up. And whenever there's an uncertainty, whenever US goes into trouble, we know for a fact that gold and silver goes up. Now imagine an economy where, of course, China is, of course, playing around with its currency, devaluing it whenever they want to. But if the US also were to devalue its currency, then what is the go-to place for us? Like, what is the reserve currency then globally, right? So there's no current reserve currency then, in which case gold will have to be the reserve currency. And which is why this rise in gold is completely justified. And I think until all of this gets sorted out, gold will remain at elevated levels. There might be some short-term corrections here and there, but I think gold is now a buy on dips trade, not the S&P, right? That is the way I would put it. And because silver is aligned to gold in terms of, some percent, I mean, silver generally trades at some 1.5%, 2%, 2.5% of the value of gold. So it will remain, if gold goes up, then silver obviously will do the catch-up game. Yeah, so just in terms of Nifty 50 and Nifty 500, of course, Indian markets have corrected. I'll go to the individual, charts as well. But in terms of valuation, we've come down to 20.8. The 5-year P, sorry, current P is around 20.8, and our 5-year average is 24, 25. The lowest is 19, so we are very close to the lowest in that sense. So valuation levels are not very high. From a long-term perspective, uh, if you have clarity on the sectors that will do from here, given these trade tariffs, given the trade war that is going on with China, uh, we can, whenever that clarity emerges, I think it's a good buying time. I think the only reason why we've not been able to decide in favor or against some of these industries is because we don't know how the negotiations with US happen, how ultimately China will end up dumping in India or other geographies. So, but the broader market remains under like decent valuation, not expensive at all. Similar for Nifty 500 also. Nifty 500 is currently trading around 22.9 times price to earnings. 5-year average is 27, lowest is 19, so very close to the lowest. Right. So in a way, markets overall are not at all overvalued. In fact, they've corrected and below the average. So that is something which is good. Now, our strategy going forward, this slide, like we have at all times whenever we have these discussions, just to sort of give direction on how we are thinking right now. So we are, of course, waiting for more clarity in terms of the new global trade setup. Because every other country is now negotiating with every other country. World Trade Organization, the pillars of World Trade Organization are no more intact. So this renegotiation, India with US, India with China, India with Europe, India with Australia, all of this will have to be re-scripted. And once we have these, once we have more clarity on our own export market, our own export, companies will be able to take a better call. But what we are trying to do for now is to just focus on the internal consumption stories. And we've recently released a video also. We were trying to figure out what within consumption is growing fast, because there's FMCG, there is retail, there is consumer durables, there's a whole lot of companies that get directly impacted by India consumption, and urban consumption has slowed, whereas rural consumption is still quite strong. Remains the silver lining as far as the Indian consumption story is concerned. So we were looking at some. We have not taken any position right now, but we were identifying some companies that are expected to grow fast in that segment, where the risk from US, the risk from China, the risk from Europe is not probably that high, right? Textiles, for example, textiles, हो गया, manufacturing, हो गया, all of this will have to still wait for more clarity, depending upon what will be the final rates for India, for Bangladesh, for Vietnam, for China, some of these countries, right? And we continue to build on our gold and silver position. So we are adding more. In fact, gold just crossed $32,000, $3,200, sorry, and expected to go to 3,800 or 4,000 by the end of this year. So we remain positive. We think there's another at least 20-25% upside from here as far as gold is concerned. Upside can be slightly more higher because US has still not got into a recession, right? So maybe 6 months, 7 months down the line, data will come out saying that US is actually in a recession, and then there will be a very short peak. Obviously, the last leg of the rally will be very steep, and I think that last leg of the rally can maybe take gold above 4,000 as well. We don't know. I'm just, basis behavior. If data were to come where actual GDP were to go down in the negative zone for US, there is potential that gold will keep inching higher. Of course, large cap private banks, given their valuation, and you've seen all of these banks have given breakouts, so we've also taken very heavy positions here. Pharma, in my view, will continue to be the dominant, because all said and done, there's no country globally which has the kind of capability that we have in terms of pharma, and this is not something that can be replicated easily, right? So which is where we believe that even going forward, even with all the tariffs and all, pharma will continue to be a major driver. And if somebody were to put tariffs on us, then their pharma, then their medicines and all of that will become expensive. But I don't think any country has the ability to replace Indian pharma, the cost at which we manufacture drugs here in India, right? Now, fourth bet, of course, Hang Seng Bees. We took this bet, and I'll show you the chart also. We are quite bullish, even as this trade war continues. We believe that ultimately US will give up. I mean, all said and done, this whole plan will not get executed to the best of their abilities. Somewhere China will come, give a very strong competition and say, this is not happening. You don't have those cards to actually dominate every other country in this world and dictate your terms, which is where this whole plan will go for a toss. And there will be, I don't know if there will be a actual war, but a Cold War is for sure about to happen, where China will obviously look for other markets to expand to, and ultimately emerge as the winner as part of the new world global order. And the fourth bucket, we were looking at some defense companies because I think long term, what will also happen is that if China becomes a significant superpowers, if China gets to superpower status, and India being, we share a boundary with China, right? So that obviously is a big sovereignty issue for us, and we know for a fact that China has been taking up land. They have been grabbing land, Indian land, for some time now, to which we have not responded till date in an aggressive manner. But there is a need to invest in Indian defense. So I think Indian defense as a theme has to evolve. If we have as a country to defend our borders with China, we have to invest in our own defense companies. So that's which obviously is happening for the last 3-4 years. But I think we have to up the ante. We have to invest more in Indian defense, and some innovative companies there can really be which export globally, which can basically benefit from this trend. Could be good investing opportunities. For example, very recently, we were looking at companies like Data Patterns and PTC Industries Limited. These are some companies which are really doing innovative stuff. And at the right valuation, at the right price, we might think of sort of adding them to our portfolio. And of course, the last bucket, which I discussed, is fast growing consumer bets, where, for example, value retail, V2, Zudio, Trend, for example, Style Bazaar, and some of these spaces, some of these pockets are growing at 40-45% versus the overall industry at 10-12%. So there are some buckets there where we don't have any US China exposure, but still fairly fast growing, and that could be good, interesting bets for the next 4-5 years or so. Right. So that is where I would sort of end this monologue. And if there are any questions, happy to answer. But okay, quick 5 minutes. I would want to just take you through the charts. So Nifty levels, because invariably this discussion is almost always very common. So Nifty has now taken support at the 22,000 level 2 times, right? So it's been taking support even before we reached the bull. So this was the election day correction and then the reversal. But ever since Feb 2024, this level seems to be a fairly strong level for us as far as Nifty 50 is concerned. We believe that, in our opinion, that it shouldn't get worse. It shouldn't ideally go below 22,000. But if it were to go below 20,000, then 21,300 is my worst case scenario, right? So this is where I expect Nifty to bottom out. If, let's say, for example, there's more selling, there's more FI selling, if US goes into a recession, that triggers another round of FI selling, we don't know. But one thing is for sure, that next 4-5 months, nothing is happening, right? So if I look at this lines that I've drawn, September 2025 is when I believe that till which time nothing major is going to happen. We'll probably see the markets, move something like this, and then probably give a breakout, something like that. Right. So in my view, we might see another 2-3 months till August, September at least, where we will see no significant movement. Of course, market can come down to 22 or 21,300 levels, also recover from there and then come down. So seesaw, this up and down 1,100 point movement can happen for sure by till August, September. After which I think, and this also coincides with the fact that 90 days would have passed, India would have reached some sort of agreement with US, some sort of agreement with Europe, China, all of these countries. So by then we will have some clarity on what will and will not do well. And once that clarity emerges, I think the market will be ready to sort of give another, sort of breakout and then move up from those levels, right? And I think similar is my view on Nifty 500 also. Again, here also we are taking support at the 19,600 level, where we've taken support multiple times in the past also, very recently in March. So the reason I say this is, unlike VIX, because last week we saw the VIX go up very significantly high, and even at those VIX levels, we were able to sort of sustain this level, which is why I say that it's very difficult for the market to go beyond, for example, Nifty 500 to go beyond, let's say 19,500 or 19,600. And so in this case also, I think it will just, do some time pass here and then we could see this breakout. Yeah, so this is China Shanghai index. So this is the consolidation zone. If you look at China, not just for the last 7, 8 years, ever since 2007, they have underperformed significantly. So just US-China comparison, China is at the lowest and US is S&P is at all-time high, almost at all-time high. So there's lot to lose for US from here onwards, and China can only go up, which is where I believe that Hang Seng we should keep buying. There's no real issue here. As long as these levels continue to hold, we have no issue in holding our Hang Seng, right? And we've temporarily थोड़ा सा stopped incremental buying in Hang Seng because of this trade war. We'll wait for more clarity, but net my view is that there is not much downside in China. China already has been underperforming for a very long period of time. There are very high chances that as this trade war emerges, China will have an upper hand. China will be in the dominating position. China will sort of walk its way through this trade war. And hence it makes sense for us to stay invested in China. And basically, if you have any exposure to S&P right now or a significant exposure to US markets, then you might want to rationalize some of those positions. Okay, if there are no more questions, then I'll end this.
Just a big compliment to you and your team for bringing those insights in such a turmoil situation that increases the confidence of we all as investors. So big compliments to you.
No, thanks a lot, sir. And I must tell you that, last 6 months have been really painful. But at least from our point of view, I can't say for the entire market, but we have been able to sort of retain 95% of our clients, thanks to their long-term vision and trust with us. And hopefully we'll get out of this very soon. But thanks a lot for your patience also. I know 6, 7 months have been very painful. We've not done that well. But one thing that we've been able to do is at least protect our capital, net. I know we've taken some positions where we are seeing quite some drawdown because although we were right in booking some profits and moving to large caps, but we didn't do it for the entire portfolio. We held some stocks. We continue to hold some stocks because fundamentally we thought that we should hold them. And of course, the FII selling and the market correction has been really, really painful. But thanks a lot to all of you for holding. And I think in another 3 to 4 months, we should, from here onwards, get back to making money, serious money.